Assalamu alaikum everyone, Jehanzaib here once again to give you an update on what's going on in the international oil market. First of all, over the past 2 or 3 months, the international oil prices have been really volatile, touching a high of around $138 per barrel during the early days of Russia-Ukraine war, but then easing off significantly to around $105 per barrel more recently as fears of a resurgence of COVID-19 in China resurfaced. We believe that opposing forces currently at play in the international market are going to keep the oil steady at current level, where the move to the other side is expected to be short-lived. Let's discuss the demand side factors first. Firstly, the resurgence of COVID-19 in the world's largest oil importer, China, has dented the sentiments. To this end, China used to import around 10.2 million barrels of oil per day throughout CY21. However, its demand had increased to around 15 million barrels before it went into the lockdown. Also, US Fed recently increased interest rate by around 25 basis points, while also hinting that it's going to increase the interest rate cumulatively by 150 basis points to 175 basis points throughout CY22, which will dent the demand. However, these risks are balanced by supply side constraints, where the international market is currently short by around 1 million barrels per day. The situation is not helped by the Russian conflict, which has put additional 3 to 4 million barrels per day of supply at risk to Western sanctions. In this backdrop, the upcoming OPEC Plus meeting is of great significance, as the market is anticipating OPEC to raise its output by 400,000 barrels per day. However, the analysts are skeptic about OPEC's ability to raise their supply in the short term. Amongst all this, the Russian-Ukrainian conflict continues to remain a major black swan event for the market, where the settlement of the hostilities will put a certain downward pressure on the oil prices. However, the prices will not stay down for long due to the current short supply in the market. What this means for Pakistan is that higher oil prices will not only put further stress on country's current account deficit, it will also squeeze government's fiscal space. Recently, government announced to keep the end consumer fuel prices stable at current levels, and the package was worked out assuming oil at $80 to $100 per barrel. And the total package was worth around 250 to 300 billion rupees. Higher oil prices will not only result in a higher financial liability, but will also make the parleys with IMF that bit more difficult.